All right, welcome back. In case you're just joining us, it's Moneyline with me, Nnaji, and I've done the first segment of the show, or at least the first quarter of the show, where I did the market analysis of what is happening currently in the country as well as globally. Dr. Aduloju is joining me right now at the table, or he's been here, in fact, so I am joining him. He's the Chief Operating Officer as well as a Senior Fellow, Nigerian Economic Summit Group, NESG. He joins me this morning. Welcome, Dr. Aduloju, and thanks for joining us on the program.
Thanks, Nancy, for having me. And it's good to be here under the circumstances.
Under the circumstances, isn't it? Where should we actually start from? Let me start by asking you what your reading is about what is happening at home as well as globally.
Well, I think we have to accept that the COVID-19 virus has triggered global uncertainties, and those uncertainties are not restricted to Nigeria. The supply and demand shocks, which your initial presentation at the start of the show pointed to, are also global, both in scale. Financial markets are having the heat across board. Investor confidence is having its hit across board. Consumer confidence is having its hit across board. So you're not dealing with typically a national issue first. You're dealing with a global crisis. Of course, the key issue with that is that has now triggered our own unique set of external shocks that have fundamental impact on the Nigerian economy, because we're primarily still an oil-led economy. And of course, oil-led dynamics will play to oil-led economies when we take the kind of hit we took in a few hours. So across board, what you see is that the oil-led economies are responding with the standard volatility management strategies and frameworks. You saw Russia post the fallout on talks, defend its economy with $150 billion. You saw the emergency meeting by Congress to defend Shell investments also. You saw Saudi also bring out his war chest to defend his economy. That's what happens to when you are an oil-led economy. Volatility management becomes part of your national and institutional capabilities. In our case, of course, fiscal and monetary buffers are simply not available because of where we are. We are having a sluggish recovery from 2017 post-recessionary effects and sluggish growth. What that means is that we are not where we are ready for this particular level of volatility in oil prices. And so the natural panic we're seeing is expected. Well, like the minister said, it's not about panicking. It's about deploying short, medium, and long-term strategies to respond. The virus will be here with us for a bit. You can see that Trump is still responding. Europe is still trying to figure out a response. So uncertainty in the global sphere from COVID-19 hasn't stopped. We just declared it a pandemic of World Health Organization yesterday. So those will stay. So locally here, the questions we need to ask is, what do you do to buffer the fiscal side? What do you do to buffer the monetary side? And is there anything trade or restructuring our terms and volume of trade can do to manage where we are in terms of pricing infrastructure and opportunities, as the case may be? But I think generally that's where we are. Demand and supply side shocks have taken effect across board. We are dealing with a consequence, the cascading negative consequences of that. And so I think that primarily that's where the world is. And so when you begin to look at our responses here, we have gone into this with weak GDP growth. We've gone into this with inflation that is moved from 11 to 12.1%. We've gone into this with reserves that have dropped to 36.2 billion. And so the big questions today is, what do you do? We've also gone into this with debt to GDP growing from 19 to 25%. So in thinking through our responses in the short term, a big question with the external shocks, for example, is how do we rearrange or restructure our debt and maybe do some more domestic borrowing as a way to mitigate the huge cost of external borrowing costs, which will be with us in the short to medium term. That's something we need to think about immediately. Of course, reviewing the budget, which the Minister of Finance and the committee gladly has started to do, is critical. I mean, if the oil benchmark price was 57 when we were thinking about it, and we are now in the 30s, it begs the question, are we going to cut the budget, take a knife and cut the budget? Are we going to reprioritize the budget? Is there going to be some better expenditure targeting that is more different? And in terms of the debts we are already collecting in the pipeline, are we going to restructure the targeting of what those debts are focused on? That will be something we can do also that can have some immediate impact on where we are. But it's good signaling that the monetary and fiscal policy authorities are at least saying they need to talk. Of course, multiple exchange rates is not good for us. So monetary policy consolidation in that regard is crucial. We may want to look at this our price determination policy for fuel prices also. So the thing is, there are no longer any easy way out, no simple solutions, all tough choices, but that's where we are. And so I think the response has to be one that has less fear, more heads in, hands-on, and then we have to ask a broader question about economic diversification, which is primarily why the Nigerian economy remains vulnerable, right? To really be a non-oil dependent country, we must then go to the factors that the industry leaders were pointing to at the consultative conference yesterday, where one, you have to look at the factor conditions, access to power, the costing of infrastructure. Must government directly be the investor in all the infrastructure? When do we take our national infrastructure talk, rearrange it so that it is more conducive and more attractive to private capital? Because we must take an aggressive approach to FDI attraction. And part of doing that is to convert our infrastructure stock into more bankable FDI projects. So these are, so in the short term, we must deal with the fiscal and monetary response quickly. In the longer term or medium term, we must come back to this conversation as to what is our stance on trade. I was saying, last time we met, just a week ago, I was saying that the oil dynamics is still playing to how we are responding to trade policy, where we shut our borders down thinking that, for example, that will be a sufficient long-term strategy. But now we can see from oil dependence that if you do not open your borders and you cannot efficiently export, right, within a competitive regional framework and global framework, that you're still prone to these shocks. So it's ultimately, we must do what our peers, our 1960 peers have done, increasingly diversify in a way that allows us to have resilience in the non-oil sector. For now, most of the non-oil sector dynamic will respond to the oil dynamic, which is oil is our gravity. When oil moves, everything else follows.
You know, it's very, very, it's a very difficult one. I'm not even part of the people, you know, deciding what's happening for the economy. It's difficult for me to even say these things, you know, because seeing these things on a daily basis, it's difficult to be sometimes the bearer of bad news or the bearer of a news that is not as good as it is right now. If we go over to what you've just said, because I allowed you to speak for a while, you said a lot of things that are fundamental, and I hope we'll have time to take a look at all of that, because each one of them is overblown. Is a whole issue of its own. But let's talk about the response that we're seeing right now. Are you encouraged? Are you happy with the kind of response that we're seeing so far? Since this thing happened, I think over the weekend, the president has set up a committee. The committee, I guess, should be meeting. They should get back to the president with recommendations. And I was also seeing in the news, some people are getting these things twisted. That the consultative roundtable yesterday will get back to the president, or people were alluding to the roundtable as federal government's team. I'm like, it's not any federal government's team. It's a stuff put together by the CBN. This was not the first time. This is the second time. But for me, the way I read it was like it was an happenstance, but whatever it is, any help we can get now, we should take?
So I think there are two things. The roundtable is a series of roundtables, and very likely both the agenda for the roundtable and the roundtable preceded the crisis. So I think what the stakeholders tried to do was to speak to the agenda of the roundtable, which was going for growth, right?
Yeah.
We must go for growth, right? But I think that therefore, the agenda, if you look at the agenda, it spoke to the broader growth issues, big issues and factor conditions like power and the fact that the power market has not performed, infrastructure, the huge deficit that translates into huge logistical costs in our supply chains, therefore making us not price competitive even when we make in Nigeria. So I think the industry leaders have spoke to those things, and rightly so, within the context of going for growth, had their say on the agenda. I think when you now look at the crisis, right, the crisis requires the shorter term fiscal and monetary response, and those then are matched with the medium-term, long-term strategies that the industry leaders were alluding to in the broader recommendation. So I think we should be fair to the CBN and kind of put the roundtable within the context of the series on growth that it was having. Okay, so that deals, like I said, also with the question of we need to be careful about policy making that is based on adhocracy, where monetary policy is doing its thing, fiscal policy is doing its thing, trade policy is doing its thing. So synchronicity of trade, fiscal, and monetary policy within the context of the Nigerian economic agenda where the priorities are clear is crucial. So for example, there's a direct correlation between the scheduling of the opening of the border, the trade policy of Nigeria, the trade facilitation of Nigeria on export revenues. Now, if you say you want to be a non-oil economy, we discussed Nigeria beyond oil, for example, within the national export strategy. That is directly tied to our capacity to sequence trade. Fiscal and monetary policy alone can't do it. So the conversations we must have in the medium term, that is when we have dealt with our volatility. So volatility management is a short-term thing. So I think what the minister will do in the short term likely is reprice the benchmark within the budget, likely a review of the budget. But I know the National Assembly has also set up its own committee, okay, to engage on the benchmark price, right? And that will likely translate into a plan. So am I happy? Yes, I'm happy that there is a committee sitting thinking about it. And we should not preempt the committee's resolutions and solutions and proposals that we put forward to the president. But it's a welcomed development to provide support. Like you said, both public and private sector need to have heads in, hands-on on this conversation, and to get everyone ready for difficult choices. So the question, for example, about do you devalue the Naira becomes a conversation you must have.
That came up yesterday, and I must say, at that roundtable, Godwin Emefiele, who is the central bank governor, made it clear there is no devaluation. He's not going into that. Because even when his own group made their presentation, the presenter did say that the governor was head on and said, we're not going anywhere on that. But a lot of people expect a devaluation, because even right there yesterday, some people, even some multilateral organizations that I had some discussions with, some of the officials were like, don't you think that there should be evaluation? I was like, let's see what Emefiele does.
Well, the thing about it is that for some reason, devaluation is a bad word, and it comes from our history. Okay, it comes from structural adjustment programs and the big hits we took from it. But Ghana devalued a few years ago, and Ghana has come out of it stronger. So devaluation in itself is not a bad thing within the context of a coherent set of fiscal, monetary, and trade strategies and policies. Okay. And if it needs to happen, we need to look at where our reserves are. Of course, there are options available to the central bank other than devaluation. For example, we could float another bond and price it rather as uncompetitively as it was priced the last time, and get it oversubscribed because it's interesting to investors. That would be an interesting direction to go. But like I said, in the short term, restructuring our debts an increasing domestic borrowing that guarantees that we reduce the short-term risks to external factors could be a way to go. But there are no, like I said, there are no easy answers.
Way out.
Yeah, if we're looking for a silver bullet, there's an easy way out. We simply are not there today. The easy way out are the big fiscal and monetary buffers that countries save in advance of this crisis. If we must remain an oil-led economy, we must think in terms of volatility management. If you remember, the Russians suffered heavily in 2014, 2016 crisis.
And I think they prepared.
Yeah, they weren't ready then.
Yes. And that is why they can go into a war with Saudi Arabia, because I think they have a buffer of about $150 billion. Meanwhile, Saudi Arabia has a buffer of over $200 billion.
So it's not new, right? So if the Russian budget below $42.5 goes into deficit, and they are now ready to finance that. So the thing about it is that it's global. The question is whether you have the pockets for the response.
No, let me borrow what Lagarde said when she was in the IMF. She said, with what you're just saying now, I think in our case, borrowing her word, we should not just only have the pocket, which is the wallet, we should also have the brain and the heart. Because when she was in IMF, she said IMF has the brain, the heart, and the wallet. But for Nigeria, as we go into taking from where you've said, not just the wallet, now we should also have the brain and the heart, because it's going to be difficult times for our people.
But we do have the brain. I think the president has a competent Presidential Economic Advisory Council.
They've not spoken since it happened. In fact, I was even expecting them to be at the consultative forum or roundtable yesterday. I don't know if they were invited or perhaps just let them
but there seemed to be a press release from them that basically said on the heels of the price crash, they had issued a set of advisories to the president, and they did not want to preempt the president's decision with statements at the roundtable. The NESG yesterday issued its own set of advisory notes, some of which are the things I'm saying now. And we hope that that the brains in the country form this collective cluster of actors that allow us to make better choices. And of course, the minister's signaling tells you that she's ready for the tough conversations. So I think the Minister of Finance's conversation and the committee gives a sense that at least we will be willing to bite the bullet on the very difficult choices ahead.
Let's see what they come up with. But Mr. Chukwu is back online, not on Skype now. Let's try as much as possible to get him on the phone lines. You know, sometimes network connection will just want to spoil your mojo. But let's go ahead. Mr. Chukwu, are you there on the line? Good morning, if you can.
Nancy.
Good morning. Good morning. Have you been listening to what we've been saying? Have you been watching? Dr. Aduloju is here with me from the NESG. Okay, let me come to you with another dimension to this thing. During my analysis, I did speak about what's happening around the markets right now. It's bloody since over the weekend. It's been bloody and it's not abating. We saw a bit of reprieve on Tuesday, but our own market has been suffering. Speak to me about what we're seeing right now from a health crisis, which is a human crisis, which has moved over to a market crisis. We hope it doesn't get into an economic crisis, or I don't want to say the financial crisis like we had in 2008, because at least the financial system is a bit stable now. But speak to me about the market crisis that we're having right now in Nigeria. Should we even call it a crisis or a correction? It's not a market correction, is it? So speak to me about what's happening.
Well, Nancy, it can be a correction, because if your market is moving in negative territory, it can be a correction. It's only if the market has recovered was actually positive previous time. You said it's a correction, because if the market was overvalued, and then you see a correction, the market prices are adjusting downward, so that the market values should represent the intrinsic worth of those companies. That's when you talk of correction. As it stands today, we are seeing a bloodbath. And the last time we saw something of this nature was in 2008, during the financial crisis. I think the past 3 days of the trading sessions, we've had the market lose close to 10%. On Monday, it lost 2.41%. Tuesday, it lost 4.91%. On the yesterday, it lost 3.35%. So that's the correction. We are facing a difficult situation. Of course, if you look at what's happening in this market, it mirrors the panic that's available in the entire market. Look at what's happening in the FX market. If you observe the foreign exchange market, the foreign market, there was no supply yesterday. Everybody wanted to exit. People are ready to buy dollar at any price. Those are indications of panic. So we are seeing the Nigerian market in a panic mode. But the interesting is not just Nigeria is going through this panic mode. You did mention earlier that what stock exchange on Monday actually was very bad. We saw NASDAQ, S&P 500,
Dow Jones Industrial Average.
Jones,
yeah.
Yes, all of them lost above 7%. We saw London Stock Exchange losing about that range. So it's really a crisis situation because the world has moved. The coronavirus has moved from a medical emergency to a political crisis and now an economic crisis. Of course, we saw the U.S. president coming up with a directive that they're going to shut down all air communication, air transportation between them and Europe and continental Europe. You know what that means? That you are shutting out the entire world. Because what he has done is to influence America, so nobody should come in. Because if you consider the fact that most Africans that go to Europe, go to US, fly through Europe. Many Asians that go to, most Asians that go to US also fly through Europe. So if you shut out European airlines or air transport between US and Europe, you are shutting out almost the whole world. And then we've seen that crisis develop into also a crude price war. Because if you remember that the agreement between OPEC and Russia has been on for more than 2 years. So what has happened? What changed? What changed was because we saw a drop in demand as a result of coronavirus. China, which is the largest importer of crude, had to shut down many of their factories, and that led to significant reduction in demand. And because of that, that created oversupply in the market. And an attempt by OPEC now to ask for further cuts was resisted by Russia. That's all what created it. I said Russia recently led Saudi Arabia to decide to use the nuclear bomb option to bomb everybody out. And the decision to increase production from about 9.8 million barrels per day to 12.3 million barrels per day means they will be oversupplying the market additional 2.5 million barrels. And this is a market that's already beginning with oversupply. I'm happy that the GM NSP said we have about 50 cargoes or sold for April production. So that then means that as a country, we are facing a severe economic crisis. Look at our reserve. Our reserve has up to 3.6%, 3.36 billion. And that is gross reserve. That does not take into consideration the volume of foreign portfolio investment in that reserve. If you adjust for that, we may not be anything close to where the comfort zone we think we are.
Okay, since we are not in a comfortable zone at this time, since the World Health Organization has declared it is now a pandemic, because they hesitated to declare this a pandemic just some weeks ago, but now they've declared it. How do you think that investors right now should begin to trade this pandemic situation? How should they begin to trade the dip that we're seeing, especially locally? That's the A part of the question. The B part of the question is, for those perhaps that do have money right now, where should they put their money? Is stocks with what's happening, the turmoil, or bonds? Or should I just leave my cash in the bank? Or should I just also convert my cash to USD, which is the currency of choice right now?
Okay, let me start from the second part of your question. What is happening today is people are running for what we call flight safety. People are moving away from local currency instruments to foreign currency instruments, even if the instrument is just in liquid format, that is just in dollar cash. Because at a good price of $30, $40, the reserve will come under severe pressure. Next, I looked at the capital importation for the fourth quarter. It had dropped from about 5.6 billion, and we received in the third quarter to only 3.8 billion in the fourth quarter. So we've seen a progressive drop, right, starting from the first quarter of 8.5 billion to second quarter of about 6 billion, third quarter of about 5.6 billion, and now fourth quarter of only $3.8 billion. That's what we received as capital importation. The portfolio investment had dropped to just about 1.6 billion. So what does that tell you? That foreign portfolio investors are no longer even interested in coming to your market. Foreign investors have actually shared away from you. We'll be receiving just about $200 million in a quarter for the first part for the entire 2019. So the alternative source of capital inflow into the country has dried up, which is foreign portfolio investment. Then you're now facing a situation where even your most reliable source of cash flow, which is your crude sales, has not just dropped in price. It's also not. You're also having unsold cargoes. So you have double whammy. Your price at which you sell your crude has dropped drastically from the last year. Average OPEC crude price was $4 per barrel in 2019. Today, you are not talking of an average crude price of about $34 per barrel. Today, at today's price. So what does that mean? That you on average, you're going to use about $30 per barrel. So how are you going to sustain your current exchange rate? It almost looks impossible. And unfortunately, our reaction seems to be delayed in the sense that I expected the monetary authorities to respond timely. Because when you don't respond immediately, you will now be boxed into a very inflexible corner where you can only have one or two options. And that option is a massive devaluation if we do not adjust. Again, the monetary authorities came and said that private sector operators, business other than banks cannot invest in Omo. What that did was it denied the Omo market some level of liquidity. So foreign direct investors are staying away from that as well because they're saying that the only option I have is to the money market operators, that is banks. The major portfolio managers in the country, which are the pension fund administrators, cannot buy. So you're taking out a chunk of the market participants and therefore made that product less attractive.
Okay, Mr. Chukwu, I will halt you. I'm sorry, I will halt you here because I want to quickly conclude with you, then come back to Dr. Aduloju. But answer that my question quickly. If you still have money, where do you put it? If there's still money, but how many of us have money? Since close to 100 million of us are poor. But for those of us that are not within the bracket, where do they put their money? Fly to safety, invest in USD, very quickly.
Okay, if you have money now, I will advise you buy.
No, it's not me, oh. I don't have money, oh.
I know you have money.
I'm looking for it. Forget this money line with Nancy. But go ahead.
You can't be advising all of us and you don't have money.
Okay, go ahead, Mr. Chukwu.
Okay, even that you have money, put your money in Eurobond today. That will mitigate against exchange devaluation, possibly. Second, if you don't have enough money to put in Eurobond, convert to dollar and put in Eurobond, then the other option I would advise is to go for fixed income instruments. So at least you have an assured yield, and we're also seeing an expansion in yield so far. Of course, the bond market is responding to the situation we have today, and you're seeing some expansion in yield in the bond segment of the fixed income space. So your next approach should be to go to the bond market. Current yield is still below inflation rate, and then of course, you have to be ready to face the exchange rate devaluation risk.
Okay.
But first recommendation: Eurobond. Second, fixed income instrument. The equity market looks very choppy now. You must have a huge staying power to go into the equity market. If you have a large watcher and you're ready to take that out, then you can do equities. Some of them are underpriced today.
Okay, I think I'll take you up on that in days to come in terms of how to perhaps trade these bear markets which we've entered, because bear markets too can present an opportunity for those that think that they have the muscle to muster perhaps some of the risk and perhaps saying that it will come back. But many thanks, Mr. Chukwu, for joining us on the show today. Now, let me move over to Dr. Aduloju. So many things to look at. I pity myself this period, though, because really, it's crazy that so many things competing.
Yeah, I mean, and the thing about it is, if you think about the impact on China's capacity to trade even with Nigeria. 72% of our exports to China is crude. That tells you immediately. I mean, last year we did $10.8 billion in terms of exports to China. So the China as one entity is a big part of our capacity to deal with this. So looking at the news out of China, when you hear the virus is, the spread is slowing down, all that is, any type of good news out of China is really good news for Nigeria, because they are our biggest trading partner. We can't ignore them in thinking through a response. Actually, in trade deals where we are already in bed with China, repricing some of those assets could be an interesting way to go. It's a bit more sophisticated, but it's possible. So, for example, taking a rail deal and extending it by a couple of more years and seeing whether there can be drawdowns can be interesting ways to look at it. But of course, our sympathies, they are the worst hit, you know, and their capacity to trade with the rest of the world, and particularly with Nigeria, becomes a big downside risk in terms of the impact of the COVID-19.
The question, or what we are not also looking at as Nigeria in the midst of all this, because ruminating over all these issues, looking at, okay, this is what I'm going to be talking about and all of that. The conversation I've not also heard is the African Continental Free Trade Area in the midst of this economic challenge. July 1st is the target date for the first commerce under the AFTA. Do you see that happening? Meetings to iron out details are being slowed down now because of COVID-19 spread. I think there's a Secretary General, not new because it's just first. I think it's South African also. The Secretary General, Wankele Meniel, so I think that's his name, is to resume work April 1. Where's Nigeria in all of this mix? In the mix of, after taking off with this crisis, in the mix of Nigeria was like, we're one leg in, one leg, nobody understands us. Ghana is where the Secretariat is. The commerce is to take off in just a few months away.
So COVID-19 aggravates everything. However, before the crisis, Nigeria's posturing on the African economic integration has really been slow and noisy. Noisy in the sense that our speed of prosecuting the ratification of our agreement has been slow. We thought by now that we'll be a state party in the African Free Trade Area, negotiating terms of trade and shaping the policy and the direction. We are still a country that is outside the trade area because we haven't ratified our agreement. That's worrisome. We have constantly advocated to government that we should proceed with it. A state party in the trade area negotiating is more powerful, more potent, and more effective than a trade party, than a state party outside the trade area having conversation. Trade itself has been in recession already. So it's not, we're not doing fantastically well overall in trade. The short-term benefits of a closed border have already crystallized, higher demand for local goods and services. And the way it has worked in spite of high inflationary rates. So rice, for example, went up. So yes, there's a higher demand for local rice, but at what price? And then it goes back to the pricing of logistics, for example, where there are huge infrastructure deficits. So the way to go, one, is we must get back to this urgency to create a national trade policy. We still do not have one. And it is, it's frightening that a country of Nigeria's size is running ad hoc trade policy. There was a call out last year for a 21st century trade policy for Nigeria, but taking it forward and concluding it so that we have a clear trade policy for Nigeria that defines our priorities, that defines our focus, will allow both export, import, and some of these other fiscal monetary measures as it impacts trade to align. Now, in the absence of that, you can see the noisiness in trade negotiation and trade facilitation. We go into it and people ask, does Nigeria want it? Is it good for Nigeria? Is it not good for Nigeria? All those conversations are coming from the absence of a trade policy that is guiding trade negotiations, that is guiding trade facilitation. So one day we say it's good for a group, the next day we say it's not good for some group. Those conversations have to end by concluding our national trade policy, signing the ratification instrument for the ACFTA so that we are a state party in the market, negotiating and shaping the conversation. And if you remember, Nigeria was the leader, is the leader of economic integration across Africa. 1974. Yeah. It then doesn't make sense that we're outside the process afraid of the rest of Africa. A prepared Nigeria, and we can be ready. We have a readiness report, an ASVA readiness report that defines the dimensions of readiness and what it takes. We are not seeing the synchronization of institutions to move quickly on the readiness report. And so it's trade leading the conversations, but the pace at which we are resolving the readiness issues is too slow. Well, that becomes item number 3. Item number 4 is whether we like it or not, the phase 2 conversations have started. Intellectual property, big issues on services in Protocol 1 that we must resolve, but we can't resolve them outside the trade area. Arguing about what should be inside. We should be inside as a state party, shaping it.
Okay, just quickly, sorry, Doctor, that I have to halt you because we've got to go. And I hope we had more time. But what does this say for African countries that are too dependent on the United States dollar? We're being exposed. What does that mean? How strong should our currencies be even as we move forward into CFT? I hope you'll be able to answer that quickly. We have to go in like a minute.
The regional arrangements, for example, ECOWAS, should be moving towards convergence for monetary and customs union, which allows us to have common bloc positions against other currencies. That has been very slow. We saw in December the Francophones went ahead with the ECO without Anglophone Anglophone parties agreeing. Our position on that is that you cannot have Francophone West Africa have a single reserve backed by one currency. We should have separate sovereign reserves tied to one ECO for the region, and it should be through a payment system and a settlement system that allows for the pricing of currency into one basket. And that's where we think that should go. And we've also, our position from the Economic Summit Group has been laid out clearly for the federal government to take on in that regard also. And that is the best way to position. An economically integrated ECOWAS and Africa is better for trading as a bloc with the rest of the world.
Let's see how that goes.
Yes, let's see how that goes.
Dr. Aduloju, it's so nice to have you here.
Thanks, Nancy.
We'll do this sometime again because we'll definitely do it, whether we like it or not, because we'll continue to watch. Yes. We hope we don't have another, kickback to what we're suffering right now. So many thanks for joining me on the show. Thank you for having me. All right, I've been speaking with Dr. Tayo Aduloju, who is the Chief Operating Officer at the NESG. He's also a Senior Fellow, Public Policy at the NESG. We've been speaking, at least in the last few minutes, about what's happening around the country, but I would say do not fear, do not panic. Let's see what we can do. Dr. Aduloju said earlier that we have the brains. So perhaps we have the brains, we have the heart. I don't know if we still have the heart, though, but we don't have the wallet right now. So let's put our brains together to look for the wallets to suit the hearts. I think that's the way to go right now. So that's the much we can take on today's edition of the program. Thank you all for being a part of the show. Join me again tomorrow. I'll be here. It will be a Friday show. Thank God it's a Friday, so I can go home for the weekend to take a leave. I'll see you all tomorrow. Be the best.